Hey everyone, and welcome to today's Explainer. Today, we are really peeling back the curtain on the life insurance industry. We're going to look right past all the shiny marketing and the routine premium payments to examine the incredible multi-layered defense mechanisms that actually keep these massive financial institutions standing.
It's a fascinating question, isn't it? Most people just casually think of life insurance as this giant gamble. Like you pay a premium and the company basically places a bet on your lifespan. But the reality is completely different. An insurance company is absolutely not a casino. It's more like a highly calculated financial fortress under constant siege from human unpredictability. Every single day, they face this monumental task of absorbing vast amounts of risk without just collapsing under the weight of it all. How they manage to survive and even thrive is honestly nothing short of mathematical artistry.
Okay, let's dive into this. Here's our roadmap for today. We're going to cover 4 key areas. Number 1, the core insurance risk. Number 2, the defense system. Number 3, the longevity paradox. And finally, number 4, operational threats. All right, kicking things off with Section 1, the core insurance risk. At the absolute center of the life insurance universe is mortality risk. This is the ever-present threat that people might pass away sooner and in much greater numbers than the company expected. To manage this threat, the industry relies on a fundamental mathematical rule that really acts as its heartbeat. It's called the A/E ratio, which simply stands for actual versus expected. It is exactly what it sounds like, too, a direct comparison of the actual number of deaths or survivals against what the actuaries originally expected to happen. This single ratio is the ultimate balancing act that determines whether an insurance company is profitable or just bleeding money. So let's look at the 2 distinct ways this scale can tip. On one side, we have a mortality loss. This happens when the A/E ratio is greater than 1, meaning actual deaths have exceeded the expected deaths. That's a direct hit to a standard life insurance portfolio. On the flip side, we have a longevity loss, where the A/E ratio is less than 1, meaning fewer deaths occurred than predicted. So the really crucial takeaway here is that for traditional life insurance focused on mortality risk, the ideal scenario is an A/E ratio of at most 1. A consistent ratio greater than 1 is a glaring red alarm indicating poor claim experience. And to bring this a bit closer to home, this precise balancing act is exactly why your life insurance premiums are priced the way they are. Every single policy is carefully calculated to keep this scale in perfect equilibrium.
But you might be wondering, how do they actually figure out the expected part of that equation? Well, I can tell you it definitely doesn't happen by guesswork. The pricing team assumes the likely mortality of a specific target population at the very moment a product is designed. They start with a standard mortality table, like the Indian Assured Life mortality table, for example, and then they rate it up or down. They adjust this baseline using existing data from similar groups, industry experience, and even feedback from reinsurers to perfectly match the specific demographic they're planning to sell to.
Moving right along to Section 2, the defense system.
And this brilliantly illustrates how actuarial science isn't just a static calculation on a whiteboard, it is an active defense grid. The very first true level of physical defense is underwriting. Think of underwriting as this massive physical filtration funnel designed to ensure the raw applicant pool actually conforms to those pricing assumptions we were just talking about. Notice the strict checkpoints they use: medical limits and lab reports, financial justification to make sure income matches the requested sum assured, and lifestyle assessments regarding things like smoking or high-risk occupations. By the end of this funnel, standard lives are accepted at normal rates, while substandard lives are either charged a higher premium or just declined entirely.
Now, even with fantastic underwriting, an insurer simply can't hold all that risk alone. This brings us to reinsurance, which acts as a vital pressure valve. The primary insurer practices something called risk splitting. They'll set a retention limit, say keeping the first 10 locks of a 50-lock policy for themselves, and then they literally pay a premium to a reinsurer to cover that excess 40-lock layer. This drastically reduces claim volatility. To put that into perspective and see the real-world impact of this defense, during the COVID pandemic, if it weren't for reinsurance, some insurers would have suffered losses equivalent to 2 to 3 whole years of total profit. No way could they survive that without a safety net. Let's move to the next part and see how this builds to the final defense checkpoint, claim management.
When a claim is submitted, it doesn't just get paid automatically, right? It goes through this rigorous verification process where claim papers are cross-referenced against the original proposal form. The whole goal here is to detect non-disclosure, misrepresentation, or outright fraud. By paying all the genuine claims while strictly filtering out the suspicious ones, the insurer prevents invalid payouts from artificially inflating that all-important AE ratio. All right, that brings us to Section 3, the longevity paradox. Now, you might think that human beings living longer, healthier lives would be a universal win for a life insurance company. But it's actually a massive plot twist and a severe systemic threat. Remember our AE ratio? Well, imagine an insurer has sold a portfolio of annuity products. These are the ones that pay the customer a steady income for as long as they live. If the actuaries expected 100 deaths in a given year, but thanks to medical advancements, only 80 actual deaths occur, the AE ratio drops to 80%. Because the ratio is under 100%, fewer deaths occur than predicted. This triggers a direct longevity loss for the insurer, simply because they now have to keep paying out those annuities to people who are living much longer than expected. Now, what's really interesting about this is the sheer scale of the threat. A minor demographic shift does not scale linearly. Let's say there is a sudden 2-year increase in overall life expectancy. If an annual annuity pays 1 lakh, that's an extra cost of 2 lakh per policy. But when you apply that unexpected 2 lakh cost as a multiplier across an entire book of hundreds of thousands of policies, wow, it triggers a massive systemic liability increase that can literally bleed an insurer dry. So, to defend against this paradox, insurers use an incredibly elegant strategy called natural hedging. They intentionally balance their overall portfolio by holding products that react oppositely to human lifespans. As outlined in our source material, they balance traditional life insurance with those annuity products. Because these products sit on opposite ends of the mortality spectrum, the gains experienced in one segment can mathematically offset the unexpected losses in another. It's like a perfectly balanced seesaw. Finally, let's look at Section 4, Operational Threats. Okay, so while mortality and longevity are the big, headline-grabbing risks, we absolutely have to look at the less glamorous leaks in the bucket. Chief among these operational frictions is lapse risk, which is the threat of policyholders simply walking away and stopping their premium payments. This is incredibly dangerous early on because high early lapses mean the company never recovers its hefty customer acquisition costs, which, by the way, are often driven by mis-selling by agents. If you've ever wondered why your policy has steep surrender charges in the first few years, this is exactly why. But the most terrifying variation of this is called selective lapse. This is when healthy individuals realize they don't need the insurance and leave, while the unhealthy individuals, who know for sure they need it, stay on the books. Insurers have to aggressively mitigate this through strict lock-in periods and monitoring persistency rates at the 13th and 25th months. Right alongside lapse risk is expense risk. Think about it. If an insurer expects it will cost 2,000 rupees to maintain a policy, but it actually costs 2,800, that 800 rupee excess directly eats into their profits. So where do these steady leaks come from? Well, it could be soaring acquisition costs like agent commissions and marketing. It could be operating costs inflating due to tech upgrades and salary hikes. Or it could just simply be process inefficiency, relying on manual operations and suffering from high turnaround times. It's a constant, everyday battle to keep the physical cost of running the business below those actuarial expectations. So what does this all mean? We've seen today that an insurance company is not just taking bets. They are constantly tweaking a multi-layered defense system to maintain a perfect equilibrium between actual and expected human behavior. But I want to leave you with a provocative thought to ponder. If global life expectancy dramatically jumps in the next decade due to unprecedented medical breakthroughs, will the actuarial defenses built today hold up against the multi-generational liabilities of tomorrow? It's a delicate, continuous, mathematical balancing act, and the stakes are literally life and death. Thank you so much for joining me for this explainer, and keep questioning the systems around you.